Are central banks about to become a headwind to this equity market rally?
We actually had a very good exhibit on one of our client calls. If you look at the 21 past strikes that the US has had on the Middle East or North Africa, up to 8 weeks after the initial strike, the equity markets have been up on average 4%. And that's exactly where we are. So everybody's saying, oh, the equity market is going ahead. How can they ignore the price of oil, whether it's WTO or Brent? What is exactly going on? Growth is still robust. Obviously, we're going to get Q1 numbers, but I think nobody's thinking that we're in a recession is imminent. And if you look at the earnings we've gotten, they've been incredible, right? Substantially greater than consensus. And this is a pretty significant, in terms of exceeding expectations, it's a pretty significant number. It's not like, oh, we exceeded earnings by 2%, 3%, 5%. It's double digit. And if you look at the number of quarters where we've exceeded expectations, the number of consecutive quarters, it's just incredible. And so when people talk about the impact of the war, we have said the US economy is unbelievably resilient, and people continue to underestimate that. So as we look at this, I don't think anybody knows exactly how long this will last. If it lasts a lot longer and oil prices stay at these levels, then the economy will be weaker. And so the idea that people can raise rates in the face of weakening economy, especially in the US when you have a dual mandate, I think we need to factor in a lot of uncertainty.
Do you think that there is a lack of logic when people say, well, oil prices are at this level, and you see still that robust growth in the economy? So that means that the inflationary impacts can get passed through much more directly and easily because of the capex spend, because of how well these companies are doing. Do you see that as a logical connection, or do you think it just hasn't been long enough with oil prices at this level?
There are actually 2 points. You're right. It hasn't been long enough. So that's number one, because if this war were to last and we see oil prices here, eventually we will get to negative numbers in the equity market. But for now, the idea that we're up 4 or 5% is actually totally in line with history. And from our perspective, one of the pillars of our investment philosophy is history is a useful guide. So first we have that as the backdrop that we need to follow. The other thing that people need to think about is the energy intensity in terms of usage of oil is a lot different than the early 80s. So when we had the Arab oil embargo, then we had the Iran-Iraq war, we had the Iranian Revolution, prices skyrocketed. But at that time, the energy consumption in the US in terms of barrels per capita per year were substantially higher. In fact, it was around, let's say, 30 barrels a year. That number is down to around 23, 24 now. So there's also a view that energy, crude oil, will not impact as much. Obviously, it will. Fertilizers, we hear about all of these things, but it has to last a while.
It does affect the cost of components, and we saw this with some of the hyperscalers reporting earnings last night. Meta, for example, increased their expected capex in part because of higher component costs, maybe also because of some of the transportation issues that people are experiencing. At what point does that become a sticking point, maybe not for the biggest tech companies, but for some of the tech companies out there that are facing an existential threat but are having to pay that much more to even play ball?
I think there is a big question mark about the returns to the capex for AI companies. The hyperscalers obviously have so much cash flow from other factors that they can do quite well. And if you look at their earnings, whether it was the latest reports or last year's, they're just been phenomenal. But the rest of the economy is actually doing quite well, and people underestimate, again, the resilience. If you think about oil production in the US produces double the levels of Saudi Arabia. Right? It's just incredible. You think about natural gas. U.S. has become the largest exporter of natural gas literally in 10 years, far exceeding Qatar. So as we think about these factors, people need to think that the shock is not as great. And at the end of the day, both sides want to end this war. The question is, what is a respectable off-ramp for both sides? And I think the market is saying we will get there. Well, there'll be fits and start, escalation, de-escalation, and we're going to have to go through that. And that's why we recommend our clients stay invested. Don't try to time this market. Nobody can do that consistently very well.
But in the beginning, conventional thinking was 4 to 6 weeks. We're now 8 to 9 weeks into this war. How much longer, with these kind of elevated prices, do you think the economy could withstand? Julian Emanuel says July, and then things might start to break down. Do you have a date where you're looking at?
Not really, because nobody really knows, right? If you look at the probabilities, it's not as if it's so obvious how long this will last. I think we know both sides don't want it to last July and August.
Not the conflict. How long the economy could withstand triple-digit crude?
Well, in the U.S., we're just around triple-digit, right? And we've been here before, and prices lasted at these levels for a while. I don't think the economy is going to break. We had initially expected GDP to be around 2.3 when we started, then momentum 2.4%. Now, because of the war and oil prices, we've lowered it to 2.1%. But we have a very low probability of recession, even at these levels, if prices were to stay here. I think to say exactly, is it July? Again, if you believe the resilience of the economy and adjustments, and we're talking about the U.S. that has ample crude and natural gas, right? It's really the rest of the world. And if the U.S. is a big importer and less of an exporter, then not in terms of hydrocarbons and things like that, but in aggregate, the damage to the economy is going to be much less than it is, for example, to Europe or to China.
Do you think we're moving into a phase where the offset to equity risk is increasingly gold and commodities and not developed market bonds, which increasingly are subject to potentially spending issues, deficit issues, as well as just the natural inflation in the system?
That's a very good question, because all our clients are asking us, how can they hedge against the risk of war? And we tell clients that at the end of the day, the best hedge against inflation has been historically U.S. equities in aggregate. So in fact, that's why, again, we say stay invested. Gold is not a good inflation hedge and not a good deflation hedge. So the idea that gold is something you need to have in your portfolio is something we totally disagree with. We don't think it's really part of a client's strategic asset allocation. And tactically, we've actually said that when you see these kinds of price increases driven by central banks, especially initially by China and then countries like Turkey, Poland, clients shouldn't be caught up in the euphoria and the momentum of gold. And obviously, we've seen a pretty significant decline from peak levels.